Hi guys, and welcome to another edition of Talking Finance with myself. Today I've got two special guests. I've got Joanna James from Mortgage Easy, and I've got Murray Cowan from Better Mortgage Management on the line. Um, Today's topic is actually pretty simple. It's about bringing back sexiness with regards to the mortgage management industry or the mortgage management world, I suppose, if that's okay. Um, Now, I've invited both Murray and Joanna on the line because obviously, in terms of this market, you two have got pretty much the longest staying brands and biggest brands in the market. And I know that there's a lot of people now who want to become mortgage managers. But I guess the whole purpose of this is to say, hey, you guys have been in it for a long time. You know what's been done well, what hasn't been done well, and how hard it is. Welcome. Thank you for taking the time to join us today.
Thanks,
Wonderful to be here.
Awesome. So if I can actually just how do I put it? Ask with regards to what do you guys see as your roles are? Because I look at, from my point of view, a mortgage manager is someone that gets the application, processes the application, settles the application, and then they also look after the client until the client exits the particular loan, right? Whereas a broker, they don't. The broker just introduces the loan, and that's pretty much it. Once it's settled, they technically can't look after the client. They look after it in a different way, but they can't look after it and go, hey, your loan's not up to date, your interest rates have gone up and so forth, or gone down. Can we have Murray? I'll pick on you first, actually. Discuss what you guys do.
Correct what you've said there, Dean, and I recall that you worked for a mortgage manager for a while, so you should know what you're talking about.
I should know.
So that's good to see. Lenders, the funders representative is another term that's used. And I guess that's one area where perhaps a mortgage manager's role differs to that of a broker. Whereas especially after BID, or the introduction of BID, a lot of brokers are very much advocate for the consumer and doing things on behalf of the consumer, and have to put the consumer's interest before their own. Whereas we have, I guess, a couple of different areas that we have to look after things. We have to look after things on behalf of our funders that fund the loans, and also on behalf of brokers and customers to make sure they're looked after as well and that they get a good deal. So that's probably one of the main areas that it differs, and certainly if somebody is considering moving from broking into mortgage management, they would need to allow for that fact that they need to also be seen to be acting on behalf of the funders. Anything to add there, Joanna?
Yeah, look, that's a fantastic explanation, Murray. I think, the other key difference is that managers tend to market their product under their own brand. And we set our own pricing in the marketplace, which is different to what brokers do. But yes, there are a lot of moving pieces with what we do, and that's down to detail processes. So construction progress, if there's a construction loan, helping clients if they've lost their card. So there's a lot of detail in what we do, but absolutely we act on behalf of the lenders. And aside from our MOMD agreements that we have with them, we also have a responsible lending obligation that's different again. And so there is a lot of complexity with what we do.
It's timely that you said with regards to BID and so forth, right? Because I think there are some businesses out there that are, I suppose, almost saying that because we are at a mortgage manager BID, we're not beholden to BID, and I feel that may not be the right message to put to the industry as well as to people outside of the industry. Joanna, you were part of a group to speak to government, is that correct? Are you able to explain sort of like, I suppose, a rough summary of what you went to get clarified and what was sort of supposedly, what is a running outcome of that at the moment?
Sure, absolutely. So obviously there was a lot of legislative changes that happened last year. And the question was, well, where do mortgage managers sit? And there's a very clear regulation, it's Regulation 26, that describes what's required to be a mortgage manager, and it's very specific in order to fit into that definition. And the essence of that was really what we've just touched on, which is that we act on behalf of the lender and we exercise the rights of the lender, which means that we have to be doing more than just introducing a loan to a lender. We actually have to be operating in the processes on the lender's behalf. Now, that varies for managers and different lenders as to how much of the processes managers do. But it's definitely more than just submitting a loan to the lender. It can be everything right up. We do full credit assessment, as an example. We sign off under DLA, and a lot of those things that we do can include arrears collection, can include the customer care, also credit assessment, all sorts of things that we do. But yes, very, very clearly, mortgage management was recognised by the government as being a very important part to this industry. It's always been a part, I know you would agree, Murray, that's had great innovation, great product innovation. We've also been, the group that's been the bridge between brokers and lenders. If you look at, the 1990s, where brokers actually started, it started out of mortgage management as a model that worked closely with third-party distribution. So mortgage management's always had a very strong tie to brokers and what we do, and we've been that bridge to be able to offer innovating products and solutions to the marketplace.
Yeah, definitely, Joanna. I think also, I guess we seem to be keeping the banks honest and have assisted in driving down margins over time. Bank margins used to be very high, 4 and 5% if we go back to the 90s, but there was a lot of competition from, in the early days, Aussie was a mortgage manager in its early days. Wizard Rams was a mortgage manager back in those days. But and certainly we think, and I think a lot of people in the industry think and understand that mortgage management has been very responsible for driving down those margins, keeping banks honest, and certainly innovation as far as products goes. And we're probably seeing that at present, courtesy of the fact that mortgage managers can offer certain products that are not available through banks, such as SMSF or all doc lending, loans for non-residents, those sorts of areas. So, keeping lending available to customers that fall into those categories and may otherwise be underserviced.
Just touching on that as well, because obviously, as I was saying, bringing 60 back to this industry, right? With regards to mortgage management industry, prior to the GFCs, like it just felt like that every broker who wanted to be one was able to be one, and then it just pretty much died overnight with the what happened to the GFC. Not many ended up continuing. Your two businesses continued, obviously, and thrived during that time. Now, brokers, everyone, it sounds like that they want to be a mortgage manager again. Can you guys basically just give a quick example what you need to do to be one? Obviously, it's not because I'm a one-man band, I get my credit license and then boom, I want to be a mortgage manager. That does not work. You need, as Joanna was saying before, you're looking after the application, you're representing the bank, and if you're representing the bank or DLA, you need your own credit team. So you can't have someone that's selling a loan and also approving the loan, because that's not how a bank works, right? So it's sexy, but it's not that easy.
Or you need demarcation of those, of the credit and the sales aspect. Without that, there can be problems that may arise. The motivation, perhaps of somebody in broking mode to got to get this customer loan approved, may be in conflict with what the funder needs if that customer doesn't meet their guidelines. So that would sort of bump heads there. So we have actually prepared something of a checklist as far as what a broker may need to consider, things to consider if they were wanting to become a mortgage manager. And as you just mentioned, Dan, something like a credit team, You need, I think with this day and age, you probably need reasonable scale as well, reasonable size if somebody's going to contemplate making that step. It's probably a lot harder now than it might have been back. It's probably 15 years ago that you're using that example of pre-GFC. I certainly remember those times. Some funders were pretty much then allowing maybe people that were otherwise a mortgage broker to start up as a mortgage manager. Soon after or even during the GFC, a lot of those people lost their ability to act as a mortgage manager. Mortgage insurers in particularly kind of cracked down quite closely on them. And not that many survived in that mode afterwards. They had to prove how they were acting as a mortgage manager with their own credit team, compliance requirements, we're subject to, I guess, quite a different compliance regime these days as well. We operate with a compliance calendar. ASIC could conduct an audit upon us at any time, and we have to make sure we've completed all the tasks that are listed on that compliance calendar in advance so that we could pass any such audit at the time. As far as the checklist goes, do you want me now to work through that checklist? Did you have anything else you want to add at this stage, Joanna?
Yeah, look, I think, the topic's bringing sexy back, right, to mortgage management. And I think, when you think about anything that's really sexy, there's an area of confidence. And so it's really about asking whether you've got the full range of skill sets, because as Murray's identified, it's very different selling and writing a loan to approving the credit. It's different to settling a loan. It's different to working in client care. So there are a lot of different skill sets that you need. So you do need to have a fairly sophisticated team, and also business processes, even just systems to run the business and to make sure that things are reported properly and that you're on top of all the things that you need to be, because you are acting as the funder in those instances. So you need to ask yourself, well, for the funders out there, could I represent the funder at that level in the way in which they would want us to make sure that we're actually, doing things correctly and still look after, the introducers, the brokers, and all the clients' needs. Just generally speaking, I think we would all agree that the complexity of regulation and lending has really increased. Like if I think back on the last 20 years that I've been around this business, I'm amazed at the phone calls that come in day to day and the types of things that we need to work through and resolve. So it does require a certain amount of experience, and lending is just getting more complicated, not less complicated, in a way. And you would really need to make sure that you had the confidence to be able to manage that properly, because ultimately you own that loan and you own any loss on that loan too. So you really need to be confident with what you're doing.
Yeah, that's a good point, Joanna. Yeah, that's one of the big differences, I guess, between broking and mortgage management is that we've got skin in the game. If a loan goes bad and there's a loss made, funders will review the files and ask questions of us. And if we haven't dotted the I's and crossed the T's, done everything properly, correctly, perhaps if the customer was actually casually employed and one of our staff recorded that employment as a permanent employment arrangement and that person lost their job at a later stage, we could have to write a check for whatever the loss is on that loan. So I guess brokers also have some risk in that regard, but I think the risk is more imminent for a mortgage manager, and that's probably also kind of impacting in some other areas. PI insurance as a mortgage manager is getting a bit harder to obtain and more expensive than it has been in the past. After we'd been with the one provider for about 10 years, they announced that they were withdrawing from the sector and not going to provide mortgage management PI anymore. So we had to shop around and find a new provider. So the premium went up probably about 20%. And so that was, and it took a while. There's not that many providers that will provide PI for mortgage managers. It's a specialist area. And I think a lot of insurance providers are probably managing their risk. And yeah, we didn't have that much to choose from in the end. So yeah, that's something to keep in mind. And it would be something that would be a prerequisite for anyone looking to move from broking into mortgage management, is to have PI as a mortgage manager. So it's certainly very different and more expensive than PI as a mortgage broker.
Just jumping as well. The other thing, like Joanna mentioned before, is the delegated underwriting authority, right? So I think a lot of brokers don't realize that you need to perform at a certain level over a certain amount of time before the fund that actually gives you that DLA or DUA, whatever it was. But sorry, it is DLA, isn't it? DLA. I've forgotten the. It's been a while.
You're correct, yeah, depending on the lender.
Yeah. So to the layperson, what that means is that the mortgage manager receives the application and then approves it. It doesn't need to go to the funder to be approved. And that can also be removed from you if it's an audit that's been found on the files and that you've had and you haven't done the right thing. So it's not always, you're not going to become a mortgage manager overnight and be able to do these things that both your business, Joanna, and your business, Murray, are able to do over the amount of time you've done as well.
It is possible, and there's not many funders that are utilising DUAs these days, so it is possible for somebody to operate without a DUA as a mortgage manager. Effectively, though, where we don't exercise a DUA, we're still preparing the file. We're effectively acting as the first signature and recommending it to the funders. And if perhaps there is a negative aspect of the customer's credit, we highlight that to the funder as well. We do a recommendation covering a report on each application, which is about 3 pages. It covers standard things. And yeah, that's sort of the level that we're required to act at. Certainly a lot of brokers have done credit in the past, maybe when they were working for a bank or a non-bank or finance company or the like. But it is certainly different to what brokers would normally do on a day-to-day basis. So
yeah. And even to add to that, Murray, the credit checks and positive reporting, ordering valuations, getting insurance if a loan needs mortgage insurance for whatever reason. So you're operating on the other side of the fence, organising all of those things. So you're coordinating to make sure it happens smoothly, but you also have to make sure that all of those things are happening appropriately to the right regulation. Yeah, so it's a bit of a flip, if that makes sense. Yeah, so it's stepping over the picket fence to the other side.
And certainly, Dan, going back to that period pre-GFC, when perhaps some funders did allow brokers to operate as a mortgage manager, any that offered DUAs quickly withdrew those DUAs, and I believe there was some problem files experienced in that period of time, perhaps where maybe the employment wasn't properly checked, that sort of thing. And certainly with the GFC, there was maybe a lot more reduction in property values than we've seen around COVID times, and property values, especially in, say, regional centres and lifestyle areas on the coast, holiday homes, that sort of thing. The property values went down a lot for those sorts of properties. We haven't really seen that this time around. This time we've seen people more inclined to go and live in those properties and work remotely, and the property values in Sunshine Coast and northern New South Wales and the like have actually gone up in value. So different times, but certainly that was actually something of a negative aspect of things at that point in time. And it probably also made it quite difficult for anybody to get accreditation as a mortgage manager. I think post GFC, a lot of the funders that operated in the sector were quite hesitant to offer new parties, anybody new that was looking for it at that stage, the ability to approve them as a mortgage manager. And yeah, so that's pretty much what happened around that time.
aware, and I can see both your businesses work in a sense where you don't actually have a direct team. So you're working with brokers in general. So the brokers send you guys the file to be approved and so forth. But we do also know that there are some mortgage managers who operate in a way where similar things, they want a broker to send you files, but then they also act as brokers themselves. So that's straddling two different businesses, isn't it? So it's not really that they're not just purely mortgage managers; they're also a brokerage themselves, and that requires totally different things as well, right?
One of the things that happened, particularly with the recent change in legislation, is a lot of people that were managers restructured their businesses because it's actually not possible to be a manager and a broker at the same time. Yeah, so there's an inherent, conflict there. So you need different licensing, you need different ways of segregating your business, and obviously every business owner needs to get their own legal advice on that. But essentially, if you're acting as a broker, you're representing the client. If you're acting as a manager, you're representing the funder or the lender. And so you can't be both. So a lot of people that had businesses that way needed to restructure how they did things, and that was an individual choice. I think across the country there are, all sorts of managers. There are managers that work with brokers. There are managers that are direct to consumers. There are smaller MAP groups. There are larger groups. There are ones that have niche lending. There are ones that have, mainstream lending and niche lending. So there's a huge variety. And I think, in essence, what makes the mortgage management channel strong is that variety. In fact, we bring variety to the marketplace. And so it's very important, while there's a uniformity around the regulations and what we have to do, it's really about individual business owners adding value to a marketplace as individuals with what we do. And that's probably the one thing that keeps all of mortgage managers together. In fact, there's a wonderful sense of camaraderie amongst managers because, it is, quite complex what we do. And we actually have a great deal of empathy and respect for each other because we understand what it is that we do. And we've had many conversations, about the fact that mortgage management will continue to grow on, and there is a very important place for it in the industry. And that's why, right now, as you said, there is a bit of a resurgence and a rise and bringing, the sexy back to mortgage management, particularly with bid, because, there's policy niches and all sorts of things, pricing niches, service niches, all sorts of things that mean that those products are more appropriate for a client than perhaps at a major. And so, yes, but it is a journey. And I think that's what you touched on before. It's not something that you just go, right, tomorrow I'm going to be a manager. There is a journey involved in doing it really well. And, the people that have ridden through the GFC and the waves of all of that are the businesses that have really robust business systems, management, expertise, skills in place. And that's really at the heart of what we do. In fact, I don't know about you, Murray, but, when you have run credit teams as a manager, you have multiple lenders and funders. So your team needs to be across 8, 9, 10 different policies. Not just one or two, right? So there is a lot of complexity to do it really well. But yes, it is a really exciting time. And, I think most of the managers, we're getting older in our years, and our businesses are getting more seasoned and more mature. And we can see that there will be people coming into the marketplace, and we want to encourage that, but we want to encourage that to be done really well, to keep the standard that we have really work so hard to maintain, and also that individualism and that independence, that we fight for in the marketplace, because to have that disappear would be an incredible loss. And I think all Australian consumers would really be disadvantaged if managers disappeared. Look, there obviously was a resurgence after the regulations of both the MFAA and the FBAA worked really hard to support the mortgage management channel. There is an official forum on the MFAA, and also, Peter at the FBAA has been wonderful in supporting the education around management. So I think both of the industry bodies, are really doing their best to make sure that we can communicate and express who we are and what we do and why we are important. There will be, upcoming events. Obviously, COVID's been challenging for everyone this year. There is a the conference at the MFAA, unfortunately, has just been cancelled. The FBAA conference has just been cancelled in person too. So you will start to see in the next couple of months, that's right, postponed, not cancelled in person, I should say. So you will start to see in the next couple of months more information coming your way, more opportunities to come and connect with people that are working on the mortgage management forums and with the industry bodies to help communicate and explain what it is that we do. So if you want to learn more about how to do it, there will be opportunities for you coming up. In terms of running the world, well, I don't know about that. I think the big boys at the big end of town probably think that's their place. We just want to challenge the status quo a little bit and make sure that the Australians all get a fair go at what they should do.
Even in that forum, there is some members of that group that are both a mortgage manager and a broker, and they've, as Joanna said, had to restructure their business, effectively two separate companies, separate staff, without crossing over. Separate compliance regimes, the whole work. So it would need to be done correctly if somebody's trying to be both of those types or run both those business models at the same time. Broadly, at what might be needed if somebody was looking to move from being a mortgage broker to a mortgage manager or add that to their business. The ACL the credit license has to be noted as being a mortgage manager and not as a broker. And the holder has to be an ACL and not a credit rep. Certainly a team with skills in the relevant areas in credit, underwriting, post-settlement, customer service, wouldn't be needed, as well as, I guess, the ability to distribute and sell the loans in the first place.
And they can't be the same person. So it can't be one person being the credit officer, one person doing the settlements and so forth.
So, yeah, you'd need a team with, or teams within the team, the overall team, indeed. PI, professional indemnity insurance, as we mentioned before, is quite different for mortgage management compared to broking. So that would have to be in place before a funder would grant you accreditation to start working as a mortgage manager. Mortgage managers would need access to Equifax reports because we have to comment on the Equifax reports when we submit applications to funders. Valix to be able to order valuations. That's getting a bit expensive now even to set up. Valix charges a fee of $2,500 per funder. AFCA membership as a mortgage manager and the annual reports that are sent to AFCA differ for mortgage managers compared to brokers. Accreditation with mortgage insurers, which may not always be easy to obtain. Obviously, we obtained ours almost 22 years ago, but I haven't had to do that recently. But my understanding is that, yes, some mortgage insurers may not be prepared to take on new partners in that regard. To meet ASIC requirements, risk and compliance plan, detailed risk and compliance plan, which includes a calendar of when the different events that will occur each year. We outsource, we have a part-time compliance manager as such that we bring in to look after that role for us. We find that useful in that they can look at things with independent eyes without being caught up in the day-to-day hustle and bustle. Somebody to look after the compliance aspects of things. There are companies that provide that service for some mortgage managers. Certainly got to have a look at and review the business structure and look at the capability of the team, what systems, technology is involved. For us, we've developed our own system over the years, and I would hate to think of what we've put into that system, cost-wise and effort and time over the years. That'd run into the millions of dollars that we've spent. Documentation, procedures, checklists, all that sort of stuff that I'm assuming Mortgage Easy would utilise as well, Joanna. Yeah, a lot of time and effort and trial and errors got into those.
Yeah, absolutely. With those quality checks, you need quality checks with everything you do.
Yep, I might point out too that we subject to audit from not all funders, but some funders choose to do audits and site visits. And in part, that's about assisting us to build a better business, best practice. And yeah, we've certainly received a lot of good feedback from some of our funders over the years, but that's part of it. Probably, possibly at the time, we think, oh no, we've got to go through this audit again, but there's a lot of benefit that comes from those visits as well. And certainly, to be successful, you'd need to have a strategy and have a product offering that's attractive to either the broker market, if you're choosing to sell via the broker market, or direct to the public, if we're choosing to distribute product that way. Yeah, a strategy that would work. Probably also need to be a fair bit of capital put aside. For us, we receive upfront commission and trial commission. Probably the trial is where we make profit, and that takes time to build the trial. Certainly the upfront gets expended on upfront commissions to brokers and fees and costs of running a business, rent, staff costs, all that sort of stuff. So it takes time to build a book and to build that trial, and therefore the profitability. So would probably need to allow for 18 months to 2 years of running at a loss before they became profitable, depending upon business model, of course. So it would need a fair amount of capital to start things off.
Can I just add as well as that, because obviously if a mortgage manager chooses to use brokers as a way to introduce customers, obviously then need to be on an aggregators panel, and the DDs and obviously the cost to get on a panel is not cheap either. So there's more than just, hey, I want to be a mortgage manager and you're a broker, submit deals to me, because that's not how it works at all.
Good point, Dan. For some of the panels that we've managed to get on over the years, it might have taken like 4 years of work to do it. So, improving ourselves and supplying feedback, and I guess waiting for time at times for the management at some of those aggregators to have time to look at what you've got to offer and provide the feedback. Possibly also looking at what's happened or how things have evolved over the years. The margins these days are skinnier than they once were. Certainly those years just before the GFC, margins were larger. But with, I guess, the onset of the GFC, that's one time when our margins became a lot tighter. I know brokers talk about that being one of the times, I think, as well, where their margins became tighter, but ours certainly did around that time as well. They've never returned to what they once were. They've probably pretty much stayed about the same. Yeah, so that's something else to consider. It's not as easy as it once was, and certainly you need to be a reasonable size and scale, I think, to make it worthwhile.
I think you raised a really valid point, Murray, because it's easy from the outside, Dion, to look at it and go, oh, there's that you will incur to run that business. You really need to crunch the numbers. Yeah. And for anyone considering it, they really need to think about that. And I think also to think about where their skill set lies. They might be very good at selling, but do they have good operational thinking? Do they have, at least a consideration, respect for compliance? When you're selling the products, you're also looking at the risk, the credit risk of what you're selling and what you're writing, right? And so you need to understand markets in a slightly different way than just broking, because it's not just about the supply, it's about the life of the loan. And that margin that Murray talked about has to sustain for several years. Yeah, it's not something that you just write a loan and you're profitable day one. You've got expenses, you've got to service that loan, you've got you have to pay for things that other institutions don't need to, like valuations as an example. they're coming out of your pocket. Every month you're going to have a valuation bill that you need to pay. So understanding the costs and how that's relative to the margin. And as Murray said, it takes time for that to build up, and loans need to stay. You can't, you know, if your writing loans are just coming off 6 months later, 9 months later, all the work you've done is at a loss. And particularly it's a mindset around building a business. Really, you know, I think mortgage management, you would probably agree, Murray, really tests your ability as a business owner, and you have to be prepared to go for the long haul with all of the parts of it. Yeah, staffing, compliance, supply, marketing, you know, you have to be across all of it. It is 100% total variety within a business. Yeah, it's not just a certain part of it anymore. And so you really have to do that analysis for yourself around where your abilities lie, who's in your team, and actually are you up for the long haul? Because this is a 5 to 10 year plan. It's not a 1 to 2 year plan, or I'll do this for a little while and get out. It doesn't work that way. It takes a long time to build up, to get to the stage where you're really going to feel confident with what you do and distribute in the way that you want to. That being said, incredible journey, but it's a journey, right? So you've got to understand what you're getting into.
Well, so I was going to say it is sexy, which is why you guys are still there.
But it is harder now than it was when we first started. So certainly anybody starting up now, we certainly want to encourage more into our sector to help make the sector stronger. But we need to be quite patient and be in it for the long haul, as Joanna just pointed out very well. So.
Yeah, and that passion that's going to make you successful is your value that you bring. You don't just become a mortgage manager to make money. You become a mortgage manager because you believe in what mortgage management does and offers for clients and brokers and consumers generally. And so unless you really have that fire, you're going to come a cropper, because there will be times where you go through choppy water, and you've got to have that North Star around why you're doing what you're doing. It's like any business really that you're in. You've got to have that clear vision around, why would I want to be a manager? What's the value of management within the lending landscape? And why do I feel that I can contribute to that in a different way? And if you've got that passion, right, you can collect the skills, go for it. But if you don't have the passion, I wouldn't entertain it.
Certainly there's it's a spirit, I'd call it, you know, like a certain spirit that you want to take on the big guys and have a go. Our sector's probably been written off at different times. GFC, COVID, whatever else, regulation, things like that. The growth of aggregation was meant to probably spell the end of mortgage management, but here we are. We're talking about something of a resurgence now, fighting back. So we're innovators, and there's certainly that innovation in our spirit as well. But yeah, it has been very rewarding for us, and I think for Joanna and Peter as well. But you've got to be very patient and have thick skin.
Well, I think, you definitely need thick skin, especially in this game. But guys, thank you so much for your time today. I'd love to bring you back later on to discuss the other niches that you guys do, because obviously, time in the game, we on the Finance and Coffee community, we hear people ask about non-resident loans. It sort of died down now because of COVID, but when obviously the borders were open and people were coming and going, that there was a need for that, and obviously your alt doc products and so forth. Those will always be there because we're in COVID. A lot of people, the small business is and will always be the backbone of the Australian economy, right? And obviously, a lot of businesses do their accounting differently, and a lot of businesses have struggled the last 2 years. So I'd love to get you guys back to have a chat about those things and basically see where those products and policies are now and where you think they'll go in the future, given that, because there's a lot of changes and there's a lot of uncertainty around at the moment.
Very good. Many thanks for the opportunity, Dan. It's been a pleasure, and good to see you again.
Thank you, Murray. Thank you, Joanna.
Absolutely. So looking forward to seeing more people entering the market.